Warning, the following program was produced for traditional broadcast television. Over 12 minutes of commercials have been removed, but interruptions are still included. Thank you for watching.
Issuing preferred equity, double-digit yields. Some say that it's the next major evolution of how capital flows into Bitcoin. What's your hot take?
The bear market hasn't really changed the thesis at all. This is designed to survive Bitcoin's extreme volatility. These 13% yields on SATA are actually sustainable indefinitely, and if Bitcoin goes up 7% per year, that appreciation would offset 100% of the dividend obligation. How is this sustainable? Well, it's really powered by the debasement of the dollar, and I don't necessarily see a reason why it would stop happening.
Government officials insist we will continue to keep you informed as this story unfolds.
Welcome to the Money Block with Matthew J. Moore, the Bitcoin-focused program that's waking the masses to the fiat money Ponzi scheme. Money is changing, and your freedom is at stake. So stick around and learn how to empower yourself for this new digital age. Now, here's your host, Matthew J. Moore.
And so, welcome, America. Welcome, world. Man, you have tuned in at the right time, right place. We'll welcome all of you Bitcoin newbies, lovers, and experts. This is America's Bitcoin-focused TV and radio show, syndicated coast to coast on Biz TV. And if you're new to this space, great. We got a lot of information to share with you. You're going to learn a lot today. We're going to be talking also about some financial tools, companies, and strategies that might be relevant. And so I want to bring this topic to you. Today, we are going to be talking and exploring, like I said, these strategies around Bitcoin treasury companies and this idea of creating double-digit yields around Bitcoin. Is it possible? Is it too good to be true? Well, we're about to find out. Today, we've got Joe Burnett. He's the head of Bitcoin strategy at Strive, which is a publicly listed Nasdaq company. So, Joe, we got a short amount of time on this first segment, so I do want to hit off strong here and talk about, just this idea about these public companies, and they're now issuing preferred equity and double-digit yields. It's being talked about. It's the talk of the town right now. Some say that it's the next major evolution of how capital flows into Bitcoin. Others are kind of pumping the brakes, going, "Hey, wait a minute. This may not be a great idea. This might unwind badly." What's your hot take on this conversation right now?
Yeah, absolutely. Matthew, thanks for having me on the show. It's an interesting conversation, right? Like, I think most people see these perpetual preferred equity products that are publicly traded. They yield 12 to 13% annually denominated in dollars. And it seems way too good to be true. And I think an interesting way to think about it is this is a completely different new form of financial product that has never really existed. If you think about a traditional company or a traditional corporation, they don't have money, they borrow money, and they buy a factory, they build a factory, they invest in people and hire a bunch of people, and they borrow that money, do all these day-to-day operations, and then 5 to 10 years from now, they hope to generate significant profits from that borrowed money and be able to pay back the borrowed money plus interest in 5 to 10 years. This Bitcoin treasury model with these digital credit securities that yield high double-digit dollar-denominated yields are a completely different model, because it's like the other companies borrow money because they don't have the money. We borrow money or access capital via these perpetual preferred equity products, but we already have the money. We have, lots of Bitcoin sitting on our balance sheet, possibly, decades worth of Bitcoin sitting on our balance sheet in the case of Strive and Strategy, which are the two major digital credit issuers. So it's a bit of a different model. And when you look at, okay, what are the dividend obligations that are owed for these products? Currently, the money or the Bitcoin sitting on these balance sheets could offset, like I said, decades worth of the dividend obligations, because we have a lot of Bitcoin existing on our balance sheet.
We got to dive into the meat of that when we come back. Unfortunately, we got to go to break, but I know there's a lot to cover. If you guys are watching this, stay tuned, stay put. We got a lot for you. This is the Money Block. What does it mean to be physically, spiritually, and financially free? The right to life, liberty, property, and the pursuit of happiness, these were the ideas that made America. But what happens to these ideas when America's money becomes compromised? What do you do when the very thing that you're working for day after day is fundamentally designed to enslave you? Whether it was a conspiracy or not, you won't believe what is about to happen in this country. Arm yourself today with the truth and build your life on the foundations for liberty. Rediscover freedom in the 21st century and grab a copy of my Amazon best-selling book, Foundations for Liberty. For just $11.99, you can support this radio show by finding a copy on Amazon or by going to mattjmoore.com. Again, that's mattjmoore.com. Don't wait, because freedom is never more than one generation away from extinction. And welcome back, ladies and gentlemen. It is round two, segment 2 of the Money Block, America's Bitcoin-focused, syndicated TV and radio show on Biz TV, coast to coast. I want to welcome all you guys because today we are talking about a subject that we really haven't dove deep in just yet on the program. I've got a gentleman that I'm excited to bring to you because we're talking about Bitcoin Treasury companies and these strategies that are being implemented. The idea of creating double-digit yields around Bitcoin. And we're kind of covering this idea of like, is it too good to be true? Well, today is the episode for you if you've ever been looking at, considering this, or even heard about a Bitcoin Treasury company and some of the product offerings that they have. But before we dive into the meat of it, and before we bring our guest back on stage, I just want to let you guys know that Bitcoin is a massive topic, and sometimes it's important to understand the monetary side of things and sound money, some of these Austrian economic concepts around money. If you're new to that, be sure to download my book, Foundations for Liberty. You're going to see a QR code right there. Just get out your phone, scan that. It's my way of saying thank you for tuning in today. It's a free gift, absolutely free, but it'll help you in your Bitcoin journey. All right, well, let's pick it up here. Like I said, we've got our friend Joe Burnett. He's the head of Bitcoin strategy at Strive, a publicly traded, listed company on the Nasdaq. And he has been front and center when it comes to these Bitcoin treasuries and the plays at hand. Joe, let's continue our conversation here. Many people who are watching this show, they're new to the ideas that we'll be discussing today, which is perfectly fine. That's why we do this show. But what exactly is a Bitcoin treasury company, and how is it different from just a regular old company that just owns Bitcoin and has some on their balance sheet?
Yeah, absolutely. There are probably like variations of the definition of what exactly is a Bitcoin treasury company. In the context of companies like Strategy and Strive, which are mostly like pure play Bitcoin treasury companies, our objective and Strategy's objective is to generate an amplified Bitcoin position in the common equity, which basically means if Bitcoin goes up a lot, you could expect, or it would be reasonable to expect the common equity to go up more than Bitcoin. If Bitcoin goes down a lot, it would be reasonable to expect the common equity to go down more than Bitcoin. And this position is constructed by issuing preferred equity, which is the double-digit dollar-denominated yield that we were talking about earlier. And that's kind of how you get this amplification. So you basically strip volatility away from the preferred equity and by giving out this more stable income, and you give that volatility back to the common equity, and that's where the amplification comes in for the common equity.
Well, and your story is interesting because you helped lead this whole idea of this Bitcoin strategy at the second U.S. public company, to adopt Bitcoin as the primary treasury asset. So when you got involved with that and started spearheading this, what did that decision actually look like from the inside? Can you share about that process and how you got sucked into all this?
Yeah, absolutely. So I worked for a company called Similar Scientific. We were the second U.S. publicly traded company to adopt a Bitcoin treasury strategy. and adopt Bitcoin as our primary treasury reserve asset. Similar was an interesting business. They were a healthcare company, a healthcare like technology company, medical device company. And in 2021 and 2020, the company was booming. It was doing incredibly well, generating a lot of profits. And then there were some regulatory changes that occurred, and the company was still generating a lot of profits, but the growth had basically gone completely away. And the board and the management team was like, okay, now what do we do? We have this profitable company. The market's not valuing it at a high valuation because it's not growing at all. What should we do? So they decided to put Bitcoin on their balance sheet. They have all this excess capital that they're generating. What were they going to do with it? Instead of paying out a huge dividend or instead of doing a lot of share buybacks, they decided to put Bitcoin on the balance sheet. I helped, lead the team and putting Bitcoin on their balance sheet and communicating that to our investors and helping pursue the strategy. And ultimately we constructed an amplified Bitcoin position similar to what Strategy and Strive do. And of course, Similar Scientific was acquired by Strive, which is where I am now. And now, like you mentioned earlier, we hold over 20,000 Bitcoin.
Yeah. And, explain to the viewers, why would somebody buy a preferred equity versus just common stock? I mean, obviously there's different strategies and purposes behind both of those.
Yeah, absolutely. They're different things, right? So the common stock is like more riskier in the capital structure. You kind of get all of the potential excess return. So in the context of Strategy and Strive, that would be the amplified Bitcoin, where there's a lot more volatility than Bitcoin. And there's also a lot more potential return if Bitcoin goes up and does well over time. Whereas the preferred equity, it's more for people that want income, stable income, but they also want less volatility, especially less volatility than the common equity, and especially less volatility than Bitcoin. So it kind of doesn't require you to be a huge Bitcoin bull per se to own the preferred equity. Because Bitcoin just needs to go up a little bit every year to offset 100% of the dividend obligations. Whereas the common equity, you need Bitcoin to go up more than, let's say, the cost of capital, or 13% per year, in order for the common equity to outperform Bitcoin itself. So it's kind of just two different products for two different investors that have different tolerances for volatility and different needs from income versus growth.
And do you find that a lot of people who have traditionally held Bitcoin in self-custody are also now interested in buying these preferred equity products because the whole yields aspect of it, or do you see just a different kind of investor buying this stuff?
Yeah, it's a good question. I think it can be a little bit of both. I think generally speaking, it's more for people that don't necessarily think Bitcoin is going to go up massively over the next 10 years, because if you thought Bitcoin was going to grow, 20% on average per year or more for the next 10 years, you might just want to hold Bitcoin. It's more for people that maybe think Bitcoin, the dollar, is going to continue to be debased. Bitcoin's going to go up 3 to 8% or 10% per year over a long time horizon and be very volatile in the process. And so you think with that, background on your perspective on Bitcoin, the dividends at the 12 and 13% that these perpetual preferred equities are currently paying out would be sustainable if Bitcoin does that expected performance, and therefore you might want to just allocate capital to that instead. So I think it's for people that are kind of new to Bitcoin and don't want the very extreme price swings and want to generate some income in their portfolio. But also people that understand Bitcoin and are bullish on Bitcoin also may happen to be buying these, as you do need Bitcoin to go up, obviously, for these to be sustainable over the long run. But as many people are probably aware, the dollar is designed to be debased. And so therefore, Bitcoin going up, well, a lot of things go up. Apples, toilet paper, water, your basic necessities go up. So it shouldn't be too surprising that a perfectly scarce form of money also has a tendency to go up over the long run.
Well, we got about 2 minutes before we have to go to break, but I do want to throw in this question here. Talk to us more about SATA, because you guys have been referring to this as digital credit, and a lot of people who may be unfamiliar with this idea, explain digital credit. How does it work?
Yeah, absolutely. So SATA is one of these examples of digital credit, also perpetual preferred equity. It currently pays out a 13% annual dividend. There's a issued target price range between $99 and $100 per share. And so the general concept is the management team can take, acts and try to meet the target guidance they've issued to try to maintain that target price per share while continuing to pay the 13% annualized dividend, every business day actually. So SATA pays these dividends every business day at the 13% annualized rate. And the company can do various things to try to maintain that price guidance. They can issue more common equity and buy more Bitcoin. They can increase the dividend rate over time. They can add a US dollar reserve, which we have, which, provides more assurance that the dividends will be paid over a specific a period of time. And so that's kind of the general idea behind SATA. It's just this high yield, dollar denominated, publicly traded asset that you obviously can access in your brokerage account.
Well, we got about 30 seconds or so, but I mean, overall, this has been pretty well received, hasn't it?
Yeah, absolutely. I mean, Strategy and SATA have, raised billions and billions of dollars. SATA is near $800 million. STRC, which is Strategy's version, is, I believe, over $10 billion. So it's definitely a rapidly growing asset class.
Well, we're gonna go deeper into this, get some more details out of you. I know our viewers are gonna love it, but guys, stay put, stay tuned. We got to go to break, unfortunately. Got to let our sponsors get a word in, but appreciate you guys tuning in. We'll be right back. You are watching The Money Block. And welcome back, ladies and gentlemen. It is round 3, segment 3 of The Money Block. I want to thank you for tuning in. You are watching America's Bitcoin-focused TV and radio show, traditional over-the-air broadcast, radio, TV. We want to welcome all you Bitcoin newbies and lovers. And so today we've been talking about a subject that we really haven't gone deep in, and that's why I'm excited to bring it to you today. We're talking about Bitcoin Treasury companies and some of the strategies that are being implemented with these companies, the products and services around these companies, and how relevant it might be for you if you're considering something like this for your own portfolio. So this is information worth knowing. But before we dive into the meat of it and continue our conversation with our great guest, I just want to remind you that I got into Bitcoin because I understood basic monetary policy, basic sound money, Austrian economics. And so it's helpful when you go down your Bitcoin journey. And that's why I'm offering you this free gift. It is a download of my Amazon best-selling book, Foundations for Liberty. You're going to see a QR code right there. You can scan that QR code, download it for free. My way of saying thanks for watching today, because you could be using your time to do other things. All right, well, on the line, we've got Joe Burnett. He's the head of Bitcoin strategy at Strive, a publicly listed company on the Nasdaq. He's been front and center when it comes to Bitcoin treasury companies. So, Joe, I want to kick it off here. SATA currently pays a high yield where, people are looking at this and they're going, I like this idea of creating yield around Bitcoin, but where exactly does that yield come from? Because, Bitcoin itself doesn't generate interest or dividends. So talk to us about that. Can you explain to our viewers how that works?
Yeah, absolutely. And it's a great question because it's very different from, a traditional operating business that may intend to generate a lot of future cash flows via selling various products and services, whereas a Bitcoin treasury company is more focused on acquiring, actual Bitcoin and holding it for as long as possible. Where does the yield come from? The yield effectively comes from the two sides of the trade. You have the common equity and you have the perpetual preferred equity. The common equity wants to buy Bitcoin, and then they want to buy more Bitcoin. And so how do they do that? Well, they issue this preferred equity, and that comes with the cost. It comes with the current for SATA, for instance. It comes with a 13% annual dividend yield. And so effectively, who's paying the 13%? It's effectively the common equity one way or another, whether that would be issuing additional common equity shares or selling Bitcoin to pay the dividend over time. And the common equity, the people that hold that are simply people that want amplified exposure to Bitcoin. They think Bitcoin's going to go up more than 13% per year. And so therefore they're willing to access capital at 13% and buy additional Bitcoin. And the people that, are buying into the perpetual preferred equity and earning the 13%, they're happy with the 13%. They want less volatility than the common equity. They want less volatility than Bitcoin itself. And they just want more stable, consistent income.
So how did that term amplified Bitcoin model, how'd that come about? Was that, can you talk to us about that?
Yeah, absolutely. Michael Saylor, who is chairman and chairman of Strategy, which was formerly called MicroStrategy, which was the first publicly traded company in the U.S. to adopt Bitcoin as its primary reserve asset back in 2020, so 6 years ago. They basically created this idea of accessing capital at good, appropriate terms for buying Bitcoin, which is long duration capital, meaning Bitcoin is very volatile. So you don't want to borrow money for the next month and buy Bitcoin because we don't know where Bitcoin's going to be at 1 month from now. We're fairly confident that over a 4, 5, 10 plus year period, Bitcoin's going to be significantly higher because the dollar is designed to be debased and Bitcoin is this perfectly scarce money. So we want to borrow capital for a very long time and then buy Bitcoin. And so that's what Michael Saylor came up with originally, was borrowing capital through a variety of different ways. The latest is this digital credit idea called perpetual preferred equity. And he constructs this amplified Bitcoin position because he and the shareholders are extremely bullish on Bitcoin. And amplified, the term amplified basically just means like making it larger. The returns of Bitcoin are either going to be up or down in the future. Amplified just makes them more up or more down in the future. And that's kind of the general idea behind amplified Bitcoin. And, as long as Bitcoin, goes up significantly over the long run and the dollar continues to be debased significantly over the long run, then it's a reasonable, investment thesis.
And for those who are buying and investing in what you guys have to offer, has the presentation or the approach for those who may be new to some of this stuff, has it changed now that we're in a bear market, or is it all pretty consistent and the same?
Yeah, it's a great question. I don't think it really has changed. I think that as we kind of talked about, like this concept of digital credit is very new. Strategy launched their version STRC in July of last year. We launched ours like 9 months ago at this point. They basically haven't been out for a year yet, or just now coming across a year, and they're very new. And we think that the best time to go out and build a track record for these products is during a bear market, because again, if you're buying these digital credit products, you want less of Bitcoin volatility. You want the consistent income. You want to know that, okay, well, if this is powered by Bitcoin and built on top of Bitcoin, what happens if Bitcoin falls 50% like we're seeing? Will the dividends continue to get paid? Will the company continue to honor and increase the dividend rate if it doesn't meet the price target or price guidance that the company has issued? And we're seeing that right now. We're seeing both Strive and Strategy do things like increase the dividend rate, have a US dollar reserve, put more Bitcoin on the balance sheet in order to make it more clear and to make the credit investors more confident that the dividends will be paid for a very, very long time. And so that's the general idea, is like the bear market hasn't really changed the thesis at all. In fact, it's kind of good to be around right now and build the track record and prove that this is designed to survive Bitcoin's extreme volatility. And, if you don't want that ride, then maybe the digital credit is kind of, for you.
So a lot of people like to talk about the risks. We've got about a minute or so before we have to head to break. But, for a company running this strategy, what are the main risks involved?
Yeah, absolutely. So as everyone is probably aware, nothing is completely risk-free.
Sure.
There's risk with everything. So there's certainly a way to make this cause problems. The biggest risk is simply Bitcoin. If Bitcoin is not performing how we and others may expect, if it consistently goes down for 5-10 years, or the government becomes responsible and stops running massive deficits and the dollar becomes an excellent store of value, then this would be a very serious risk to this entire business model. Obviously, I don't think that that's going to happen. There are risks to Bitcoin, but I think that over the long run, it's going to continue to perform very well. It's going to be very volatile, as everyone is probably aware. But I think over the long run, it will continue to do very well. I think over the long run, the dollar will continue to be debased. And and I think if that's the case, then the business model is probably more sound than most people would intuitively think.
Well, we have to run to break, and you're probably right. I don't see them fixing the dollar problem anytime soon. All right, guys, we'll be right back after this break. And welcome back, ladies and gentlemen. It is segment 4, round 4 of the Money Block. We are America's Bitcoin-focused TV and radio show, bringing you some of these new ideas around digital assets. In fact, today we got a conversation for you that's going to be really helpful, especially if you've been looking at investing in things like Bitcoin Treasury companies, the strategies at hand, at play here, and what that might mean for your portfolio. Are the double-digit yields, are they too good to be true? Well, we've been talking to a guest who's been front and center in some of this, but before I continue our conversation with them, again, I'm just going to remind you that Bitcoin is a journey. It's an education journey. And a lot of us have taken that orange pill, but if you haven't and you want to learn things like what is sound money, how does that apply to monetary policy and money in general? Well, you can download my Amazon best-selling book, Foundations for Liberty. You're going to scan that QR code right there. Second half of that book, it's great. I talk all about those things, those ideas that'll help you in your Bitcoin journey. But it's a free gift, absolutely free, no catches involved. But I do want to continue our conversation here on the line. We have our guest, Joe Burnett. He's with a Nasdaq company, Strive, and it's a Bitcoin Treasury play here. And he's been doing this for some time now. He's been on the forefront of it, and he's the perfect guy to ask some of these questions. And so, Joe, I want to take our conversation here, which is, you frequently describe Bitcoin as digital capital, and, companies should kind of treat this as their hurdle rate. For those who are hearing these terms for the first time, what does that actually mean in a practical sense?
Yeah, absolutely. I'll start with hurdle rate and kind of go from there. I mean, the concept of hurdle rate in finance is having some sort of benchmark that you would like to outperform. And if you are outperforming it, then that's good. If you're underperforming it, then that's bad. A very simple hurdle rate that normal people probably think about is simply the dollar, right? Did you make more dollars than you lost? Like, did you make dollars or did you lose dollars? The dollar itself is an interesting hurdle rate. It's an interesting unit of account. In finance, also the S&P 500 could be an example of a hurdle rate. Did you outperform the S&P 500 or did you not? And if you didn't, maybe you should have just bought the S&P 500. And so the concept of a hurdle rate is interesting in the context of Bitcoin, which I believe Bitcoin is a superior form of money. And when I say Bitcoin is the hurdle rate and Bitcoin is money, then effectively that's just saying that you shouldn't lose money. Just like dollars, if the dollars are your hurdle rate, you shouldn't lose dollars. And so if you think about your portfolio right now, it's held in a variety of different assets. Most likely it could be stocks, real estate, bonds, Bitcoin, etc. You can look at your portfolio denominated in dollars or you can look at it denominated in Bitcoin. And if you look back historically, unless your portfolio is massively allocated to Bitcoin, your portfolio is actually probably going down measured in Bitcoin, while it might be going up measured in dollars. And like, why is that the case? Well, the dollar, like we mentioned, is designed to be debased. Bitcoin is this perfectly scarce form of money that is in the process of global adoption. Therefore, it's appreciating in value historically. And so I think that that's kind of like the interesting idea behind Bitcoin as a hurdle rate, because Bitcoin is just a better money, and you shouldn't necessarily focus on losing money.
Yeah. Well, despite losing money, there is a debate in Bitcoin circles where, I mean, it's been ongoing, but the idea behind these treasury companies, they're asking the question, are they genuinely accretive, or is it just creating another leveraged exposure that could unwind badly? I mean, how do you respond to this type of criticism?
Yeah. So like I mentioned earlier, you can put leverage on Bitcoin in very irresponsible, bad ways. For example, if you borrowed dollars at an exchange and the money is due in 6 months, and if Bitcoin falls 50%, you receive a margin call, and you either need to close out your loan and take the loss, or you need to post more Bitcoin as collateral. That's a bad form of leverage, and because Bitcoin can go down over a 6-month period. If you borrow money for 5, 10 plus years, or perpetually borrow money in the form of digital credit, that's a much better way to pair. It's a much better form of capital to pair with Bitcoin, because again, we don't know what Bitcoin's going to do over a short period of time. We think it's going to go do well over a long period of time. So yes, it is introducing amplification into the market, and that's why amplified Bitcoin trades like amplified Bitcoin. It can go up more than Bitcoin, it can go down more than Bitcoin, depending on if Bitcoin goes up or down. But that's kind of the bet that people in the market are interested in making. And if you don't want to make that bet, then digital credit might be a more suitable choice, where again, you can have less volatility, actual stable income. Still comes with risk. Bitcoin still needs to go up over time, but it doesn't need to go up massively over time. And it certainly has less volatility than Bitcoin and amplified Bitcoin.
Well, since we're on these more controversial topics, I would say that some people, hardcore Bitcoiners are looking at some of these things and they're going, well, these digital credit products, they're essentially competing for, Bitcoin itself when it comes to capital. So how do you see is there a competition between capital here?
Yeah, I don't think that there necessarily is. I think they solve different purposes. I think if you are looking for a place to hold wealth and you have a time horizon of 4, 5, 10 plus years, and you want no counterparty risk, then you should hold Bitcoin for that case, right? Like that's, sound money. It's going to be there 4, 5, 10 plus years from now. It's scarce. That's a good form of capital. Not everyone has that very long time horizon. Not everyone has the same degree of conviction in Bitcoin as an asset, and not everyone is able to weather the extreme volatility that comes with Bitcoin because it's growing so fast. Bitcoin, like you look back at Bitcoin's historical performance over long periods of time, it may be going up at 20, 30, 40, 50, 60% per year on average, but that comes with a lot of volatility, where some years it can be down 50%, some years it can be down 80% or more. And if you don't want that extreme volatility, and you don't want to wait 4 to 5 years to have more confidence that Bitcoin's going to be up by that time, possibly up significantly by that time, then this is where maybe you should consider allocating more capital into these, digital credit instruments that are lower volatility than Bitcoin and provide that stable income base.
Well, since we've got about 3 minutes or so before we have to run to break, I do want to give you the opportunity to address maybe some of the misconceptions that you might see right now among Bitcoin maximalists and your more traditional finance people when they look at companies like Strive. I mean, are there any misconceptions that you want to address?
Yeah, I mean, I think the biggest one is what we talked about earlier, is that people look at Bitcoin and see it as this asset that doesn't natively produce cash flow. It's similar to gold. You kind of just hold it. And they question, how can yield be sustainable with that asset? And I think it's like intuitively like an interesting question as to like how this works. But then once you realize, wait, the dollar itself is designed to be debased. And historically, if you look back at US M2, a measure on the circulating dollars in the US financial system, it's growing at around 7% per year on average for like the last 56 years. That's pretty significant. Bitcoin is this perfectly scarce monetary asset, which in the long run, its supply growth rate grows at 0%. And so it's not completely unreasonable if the supply of dollars is growing at 7% and Bitcoin's growing at 0%, maybe Bitcoin can simply match dollar debasement over time, similar to gold. Gold has kind of gone up at around 7% per year over very long periods of time, yet gold is not a native, like cash flowing productive asset. And the weird thing about this digital credit is these 12 and 13% yields on STRC and SATA are actually sustainable indefinitely if Bitcoin can go up 7% per year, because you can look at the Bitcoin on the balance sheet relative to the current dividend obligations. And if Bitcoin goes up 7% per year, that appreciation would offset 100% of the dividend obligation for both Strategy and Strive. And so that's the general idea, is how is this sustainable? Well, it's really powered by the debasement of the dollar, which has been happening for quite some time. And I don't necessarily see a key reason why it would stop happening.
Yeah, all very well said and great points. We unfortunately we got to run to break here, but I'm excited to close out this show and maybe give people some ideas about why they might look at products like digital credit. What kind of framework they might need to have in mind when looking at this. But when we come back, we'll talk more about that. I want to just thank you guys for tuning in. We'll be right back after this break. You are watching America's Bitcoin-focused TV and radio show, The Money Block. We'll be right back after this break. AI is here, money is changing, but freedom has never been more important. I'm Matthew J. Moore, the Money Block host on Biz TV, Amazon bestseller, and Bitcoin policy advisor. Book my up to 60-minute talk, Redefining Wealth and Freedom God's Way. I'll teach your church, business, or civic group how to secure money, freedom, and faith in the digital age. This is urgent, so I'm slashing my fee from $1,000 to $500. Cover my travel, and I'm there. Scan the QR code now. Spots are filling fast. What does it mean to be physically, spiritually, and financially free? The right to life, liberty, property, and the pursuit of happiness, these were the ideas that made America. But what happens to these ideas when America's money becomes compromised? What do you do when the very thing that you're working for day after day is fundamentally designed to enslave you? Whether it was a conspiracy or not, you won't believe what is about to happen in this country. Arm yourself today with the truth and build your life on the foundations for liberty. Rediscover freedom in the 21st century and grab a copy of my Amazon best-selling book, Foundations for Liberty. For just $11.99, you can support this radio show by finding a copy on Amazon or by going to mattjmoore.com. Again, that's mattjmoore.com. Don't wait, because freedom is never more than one generation away from extinction. And welcome back, ladies and gentlemen. It is the final round of the Money Block, America's Bitcoin-focused TV and radio show, syndicated coast to coast on Biz TV. I want to welcome all you guys back to the show. Today, we've been having a great conversation exploring the idea around Bitcoin Treasury companies, the products that they offer, this idea of double-digit yields on Bitcoin. Is it too good to be true? Well, hopefully you've been here and you've been watching and learning from this conversation. Today, we've been having a great guest, but before I bring them back to close out the show, just another reminder that a free gift is waiting for you. It's my book, Foundations for Liberty. Just scan that QR code right there. It'll give you the mindset, the primer that you need when it comes to sound money and why that idea is important for the modern age. All right, well, let's dive into this. Joe Burnett is on the line. He's with a company called Strive, and they are a Bitcoin Treasury company. So, Joe, let's pick up the conversation here. You know, I want to look at, I don't know, this. You post a lot on X, and you have this idea called the singularity, like that we're in the early stages of singularity. That involves Bitcoin's fixed supply. Talk to us about, how this is related. And, we're talking about Bitcoin's fixed supply becoming more valuable with the age of intelligence.
Yeah, absolutely. So this concept of the singularity relates to a lot of kind of what we're seeing in AI right now, this explosion of artificial intelligence where technology is becoming and moving more and more rapidly than ever before, and things are changing unbelievably fast. And it's thinking about these LLMs in particular, these large language models, the frontier models, where the intelligence is either matching or vastly exceeding a human at some point. And the simple concept is, okay, well, at a certain point, if the intelligence of these AI things that we've created, these models that we've created, are more intelligent than humans, then who's to say that over time they don't continue to improve themselves and get better and better at a faster rate than ever before? And so as we're going into this age where technology is accelerating, but it actually could start accelerating even faster than ever before, we're going to enter this era where there's going to be possibly an abundance of so many different things. If we're able to create robotics and things like humanoid robots, and all of these billions and trillions of AI agents around the world doing white collar work at a fraction of the cost, well, this could explode global productivity. Things that appear to be scarce may no longer be scarce. Basic consumer goods could be more abundant and cheaper than ever before. Basic services could be cheaper than ever before. But I think it also applies to things that we store our wealth in. This is also potentially extremely disruptive to existing companies that have thousands of employees, are slow moving and entrenched in the way that they do business. If a super intelligent AI comes up and tries to compete with any particular company, it could be tough for that company to move fast and pivot. So if a lot of people store their wealth in large mega corporations or the S&P 500, there could be future disruption there. Or if people necessarily store their wealth in something like gold supply still grows at about 1.5% per year on average, and it's done so for a very long time. If these AI agents and humanoid robots and whatnot are able to find new creative ways to mine more gold, and we're able to do it quicker than before, that would be potentially disruptive for adding more gold supply to the market, and therefore decreasing the value of gold or whatever, or what it otherwise would have been. And so in the context of Bitcoin is this perfectly scarce form of money. No matter how much time or energy we put into trying to find more than 21 million Bitcoin, we'll never be able to find more than 21 million Bitcoin. So this singularity or this AI abundance is creating an abundance of almost everything except for something that is actually truly scarce. And so when it comes to storing wealth, you don't want to store wealth in something that's becoming abundant. You want to store wealth in the one thing that can't be created, you can't create more of, and that's Bitcoin.
Yeah, and that's a good case for Strive as well, a Bitcoin Treasury company. And when you're looking at this potential future, people are trying to decide what they want to do with their portfolios. Maybe they should buy Bitcoin and self-custody it themselves, but others are thinking, well, maybe I should look into this digital credit thing. What is the framework that they need in order to look at where the future is going and how this might be applicable to them.
Yeah. I mean, I would say first, neither of those are necessarily mutually exclusive. You can hold Bitcoin in self-custody, and you can also hold digital credit. I think it depends on like your priorities and your objective and how old you are and what stage of life that you're in and your tolerance for volatility and how much you actually understand Bitcoin. If you have a low tolerance for volatility, you want more stable income, and you're kind of new to Bitcoin and learning about it, I think digital credit is, perhaps a very interesting product because you can earn that 13% yield. You'll have less volatility than Bitcoin. You'll have an expert, institutional grade custodian managing and holding the private keys that, in for the company itself, and you don't have to do that yourself. But you could also start, buying a little bit of Bitcoin yourself if you have a long time horizon, you have a high tolerance for volatility, and you want to save for the future. I think both could be interesting opportunities.
Well said. And for those who want to learn more about Strive, maybe follow your work, any place that they should go check you out at?
Yeah, absolutely. You can go to strive.com. We have a Treasury dashboard where you can learn all about digital credit. You can see our ticker. It's SATA, publicly traded on Nasdaq. The amplified Bitcoin is ASST, also publicly traded on Nasdaq, so you can access it through your brokerage account. But yeah, you can go to strive.com, see a dashboard of all of our data and stats. It's updated live depending on the current price of Bitcoin. And so you can see a lot of interesting data and risk metrics. But if you want to learn more about me, you can probably type in Joe Burnett Bitcoin or on X or Twitter or also on YouTube. And I'll be talking about Bitcoin on both of those places.
I love it. Well, we got 30 seconds or so, but the question everybody's itching is, when is this bear market going to be over? Are you observing this and trying to put your finger to the wind?
Yeah, it's hard to tell. My view on Bitcoin is always take a long time horizon, have a high tolerance for volatility, tough it out, and eventually I think it'll come to an end and we'll be back off to the races.
Yep. Very, very soon is my hope. Hopefully by the end of this year. All right, guys. Well, that's all the time we have for now, but we'll see you guys same time, same place. Adios.
The opinions and suggestions expressed on this program are solely those of the participants and are not necessarily endorsed by program sponsors or any station, media company, or platform broadcasting this program. This program is a product of More Media, LLC. The information in this broadcast is not intended as investment, tax, or financial advice. Matthew Moore is not a licensed investment advisor and speaks solely from his experience and opinions. All information in this broadcast is for entertainment or educational purposes only. Matthew Moore, More Media, LLC, and the company or platform broadcasting this program is not responsible for the success or failure of any person's investment decisions or purchases. Matthew Moore, More Media, LLC, and the company or platform broadcasting this program makes no and expressly disclaims all representations, warranties, and guarantees with respect to this broadcast and its sponsors. Investing in any market is inherently risky and can be financially dangerous. Invest at your own risk.